the analysts at CRISIL. Let's see if we can actually get to them or not. So CRISIL's come out with an interesting report on Indian banking, putting a lot of different aspects in focus. CRISIL's view is that in all probability, net interest margins have peaked out for banks. However, profitability overall should remain stable, and that's because credit costs will probably come off. So let's discuss this with Krishnan Sitaraman, Senior Director and Deputy Chief Ratings Officer at CRISIL. Great to have you back on the show. So I was going through the note, just give us some sense on this. Are you expecting, NIMs to cool off significantly, or will they pretty much remain where they are? What's the house call?
Hey, good morning, everyone, and thank you for having me on the show. On the NIMs per se for the banking system, we expect them to come off by around 10 to 20 basis points for the current fiscal as compared to last fiscal. FY23, we are estimating NIMs to have been at 3.2%. And this fiscal, we expect that to be in the range of 3 to 3.1%. Essentially on account of the deposit rates picking up. So if you look at structurally in the banking sector, what happens is deposits reprice with a lag because on the asset side, the loan book is largely on floating rate basis. So when you raise interest rates, pretty much at a very quick notice, the entire lending book get repriced upwards. On the liability side, deposits are largely fixed rate. So when interest rates go up, only the incremental deposits and the renewal of the deposits, those get repriced at a higher rate. So typically when interest rates go up, net interest margins go up for the banking system because the deposits gets repriced later. In addition, there was another angle or a nuance last year which played out, which is that at the beginning of the year, beginning of the fiscal, banks were sitting on excess liquidity. Hence, when rates started going up, they did not immediately start raising deposit rates. Deposit rates started going up only in the second half of last fiscal. So that also has played a role in deposit rates going to move up over a period of time. So that will play out this fiscal, and hence we expect net interest margins to come down this fiscal.
So just a follow-up, Krishnan, basically what you're saying is that this entire deposit repricing hasn't happened. So by how much do you expect deposit rates to move up system-wide? I mean, rough estimates?
No. So what I was trying to say is the deposit rate hikes have already been announced, but that will be effective only on the new deposits so far, the new deposits which are getting raised or the deposits which are getting renewed. So this fiscal, another 30 to 35% of the stock deposits will get repriced upwards. So we're not expecting too much of an incremental rate hikes on the deposits. Maybe to a small extent, maybe 10, 20 basis points, because deposit growth rates are still running short of credit growth rates. So there has been some pickup in the last quarter or two, but with credit running at 15% growth, deposits should need to grow at maybe 12.5% to sustain that. Whereas now we are seeing deposit growth rate coming at 10.5, maybe less than 11%.
Okay, got that. Krishnan, another question now on the asset quality. You know, last quarter we saw quite a good performance across the board. There was an improvement seen for most players as well. What do you think we can expect going forward from here on on the NPA front?
So we expect NPAs to keep coming down this fiscal. March 23, we closed at around gross NPAs of 3.9%. We are expecting that to further come down, largely driven by a reduction in corporate loan NPAs. If you see the corporate book of the banks, the median gearing level of the corporates who borrow, that's been coming down over time. And what we do see is that the debt repayment ability, including interest coverage ratios and metrics like those are improving. So we expect the corporate loan book to again keep their NPAs on a downward trajectory. We're not expecting too much of slippages from the corporate loan book, which is the largest component of the banking system loan book. That said, we may be expecting some amount of slippages on the MSME and the retail segments, but these are smaller components of the overall bank books, and we have seen strong growth on that perspective. So we do expect that the NPAs to come down further this fiscal, and it's also reflected in metrics like CRISIL's credit ratio, which for the 6 months ended March 23 came in at 2.19. So that means rating upgrades are still outnumbering downgrades, which means that the potential for a large number of companies to slip downwards is lower.
By how much? You said you were expecting NPAs to come down further this year, Krishnan. By how much?
Closer to 3%. Yeah, closer to 3%. March 23, we were at 3.9%. So by March 24, we should be closer to 3%.
Okay, well, I guess the banking sector perhaps in the pink of health. Probably in the last several years we've seen, this is probably the best asset quality that we've seen. All right, Krishnan, thank you very much.
It's at a decadal low, yes.
Okay, so asset quality or bad loans basically at a decadal low. Thanks very much, Krishnan. Insightful, sort of numbers there as well. Thank you for joining in and explaining that to us. Well.